All right, well, what we're going to do right now is just simply walk through some hand formatting for the internal rate of return and the net present value. These are just some walkthrough calculations. Let's go. All right, well, this is simply some information on how to essentially hand diagram the series of cash flows in order to calculate the internal rate of return and then, of course, calculate the net present value. Essentially, when we are looking at underwriting an investment opportunity, there are three buckets of money that we need to underwrite. The first bucket is known as T sub 0. This is our equity in. How much money do we need to put into escrow in order to close this acquisition? This equity in could mean our down payment plus any costs. Those costs could include the loan fees, if any, and the acquisition closing costs. The second bucket of money that we're going to underwrite is the before-tax cash flow from operations. And remember, the before-tax cash flow is going to equal our net operating income minus the annual debt service, if any. The third and final bucket of money that we're going to underwrite is known as the before-tax cash flow from reversion. And that's going to equal our terminal value, the amount for which we sell the property when we dispose of it, less any loan balance, including any prepay, if any, minus our closing costs. That's going to equal the before-tax cash flow from reversion. Next, what we need to do is we need to, of course, reconstruct our operating statement, inflate or deflate the rents and expenses throughout our hold period. From that, then, we're going to diagram the cash flows in order to calculate the internal rate of return. For example, in this particular instance, given this diagram, we're going to hold this property for a total of 4 years. At the beginning of the deal, we're going to put in some amount of money, usually. That's our equity in. That's going to be, for example, $100,000, and it's times 0 because that's what we need to put into the deal in order to close it. These subsequent years are going to be our hold period. Right? Then what we're going to have is we're going to have our before-tax cash flows from operations. In this example, we'll just say for the sake of argument that it's $25,000 per year. At the end of the deal, at the end of our hold period, we're going to sell it, exchange it, somehow dispose of it. And at the end of that hold period, we're going to have some net cash flow when the deal closes. In this example, we'll just assume that the net cash flow at reversion is $250,000. We're going to add all this up. And we come up with 100,000 here out, 25 here in, 25 here in, 25 here in, and we add this up and we get 275 net at the end of our hold period. If we were to run an IRR calculation on this series of cash flows, we would come up with an internal rate of return of 44.79%. That is a very good internal rate of return. From this, what we're going to do is we can use these cash flows then to run a net present value string given some discount rate. This discount rate is known as our opportunity cost of capital. So there you have it. That's how to diagram the cash flows in order to determine the internal rate of return. The net present value would be a similar calculation. We just have to come up with some opportunity cost of capital. In other words, what could I get? What return could I get if I were to put this $100,000 in some competing investment? We're then going to take that opportunity cost of capital, then we're going to discount all of these future values back to present value, and then use our T sub 0 as well as the sum of these present values in order to determine the net present value of this investment.